Hi, Christine.
Hello, how are you?
Good. Did you get my email by any chance?
Yeah, you know what? I never know where to find these things. I figured, did you send me an email like specifically to me or just like the group?
No, not the group, just to you.
Just- Oh, let me see. Let me look on my other computer.
Explaining Saturday's fiasco. You tried to get into tutoring Saturday, right?
I did. I
And I
did. I
was,
did. I figured that I'm like, okay, you must have had like some kind of a glitch. I didn't check my email all
when I tell you
weekend.
what happened, don't report me to the mental health authorities, okay?
Oh God, no.
I got up in the morning on Saturday, and for some reason, I thought it was a school day. So I went in and I did the entire lecture on chapter 13, during which I was complaining that there was nobody showing up. I said, where are you guys today? Normally we get 3, 4 people at least, you know? So
Like,
anyway, I even put it up on Canvas, and then I didn't even realize my mistake till like a couple of hours later when Cornelia had a question about the tutor.
Wait, what did I miss?
oh,
Hi,
you're
Natasha, how you doing?
Hi. So,
Did you-
so that lecture was, say it again?
no, the tutoring.
Saturday, Natasha, I thought it was school day for some reason. And instead of just sitting there waiting for people to come into tutoring like Christine did, I did the chapter 13 lecture.
Oh, that's hilarious. I did just watch that. So, and it was funny,
Okay.
Bob, how,
Now you remember what I was saying? There's nobody here?
yeah, and it was, yeah, it was good. So will you be going over what chapter then today?
Oh, no, we'll do it. We'll do chapter 13 now. I'm going to do it a little different way, though. I'm going to go into Excel and try to emphasize a couple of things.
Okay.
So yeah, we'll do chapter 13 now. So you'll have two
Funny.
13s out there, or we'll get rid of one. We can vote. We'll have the class vote. Which one's no good?
I think, usually you show the slides and we only saw your beautiful face the whole hour. So this will probably be better.
No.
Yeah, it was just
Saturday,
your,
you didn't see the slides at all?
no, I had to open the slides to look at it, and it was just you.
Christmas. Oh,
So you'll be better this time.
that's God's way of telling me. I tell you, with this pandemic, you know, the days just run into each other. All right, I guess we're almost ready to roll, huh? Looks like you. Hey, by the way, you did okay in that other class. It looks like, huh?
I did okay. So yeah, so it seemed like everyone got that same, seemed like a majority was that percentage. It was like 74 or 75.
Yeah, in that class, it's like an A plus. Did she didn't give you any of those tough math problems, did she?
She didn't, Bob. Not one math problem. I
I was
was
going to say
laughing
that would be
so hard.
terribly. In her other class, if you're interested, Christine, there are a lot of what I think are difficult math methods to get the answers, and they demand you use these math methods rather than shortcuts that people normally use. And with the test being multiple choice, how could she give you just 1 point when you have to figure out that one problem where it goes present value equals face value divided by future value times r to the x, you know what I mean, with about 10 different steps. Brutal.
Is
Okay.
that 2:30? Is that 2:30 or no?
No. 230 doesn't have much in the way of formulas at all.
Thank God.
Hmm.
No.
I'm
Yeah.
like terrible at math, so
It's got formulas, but it just divide, you know.
that's all right. I
Not
can
much
do
below.
that.
Okay. So now that the rest of the world has heard that I not only did the wrong lecture on Saturday, I didn't even put up the slides. We'll consider that moot. That's a dress rehearsal for me. Okay.
Yes.
So here we go. Let's see if I can share a screen. Screen share. Okay, you see that now, right, Natasha?
Still see your face.
I'm only kidding.
There we go.
There it
Terrible.
is, right? Okay, I'm a wise guy. Nobody likes a wise guy teacher. Okay, here we go. I hope you find this chapter interesting. We're going to be going into Excel in about 15, 20 minutes and do some of the problems through there. Accounting for merchandise inventory. Up until this part of the book, up until chapter 9, had we gone through payroll, everything would have been pretty much for a service business. You know, the guy delivered the pizzas. That was chapters 1 through 5. And then we got a little bit into the bank recs in chapter 7. What we're saying here now, let's just talk about a merchandise business, meaning we buy something to sell it at a higher profit, okay? We are Nordstrom's, we are Target now, okay? So accounting for merchandise inventory. The first thing they want to start with this in this chapter, I don't know why they want to start with it, but it's okay. If you make a mistake counting the ending inventory, you have made a mistake that affects this year and next year. It affects this month and next month and doesn't straighten itself out until the third month, okay? For example, if you undercount, well, let's go through the quick slides on this real quick, then I'll go over to Excel for us. The impact of merchandise inventory. Errors in the inventory botch up all your statements, all of them. Your income statement is going to be wrong. You have the wrong income, which brings over the wrong amount to change equity, which means your balance sheet is wrong, okay? Since this year's ending inventory, this year's ending wrong inventory becomes next year's beginning inventory, statements for the following year will also be no good. Now, this is important to understand. If you undercount the goods, undercount your inventory, you're going to understate your net income. And the reason for that is if you go back to that little formula we worked on in the prior chapter, where we started off with the beginning inventory plus the purchases minus the ending inventory. Well, if you understate the inventory, you're going to make the place look like the cost of goods sold was real high. You're going to look like you sold a lot of stuff when you really didn't. So if you understate the net income in the month of January, January's net income will be understated and February's will be overstated by the same exact amount. There's nothing you can do about this. We're talking about mistakes that occurred. You didn't catch up to this until the middle of the next month. If this happens in the real world, you got to make a judgment. Is it significant? And if it is, you got to get the word out to the community that's interested in your company. You might, if you're a big company like Microsoft, you might have to hold a press conference and announce to the world. When we were counting the computer chips, Bill Gates' son-in-law didn't count these boxes in the back here. They're worth $10 million. We're 10 million short on our income this month, and we're going to be off the other way. Overstating an asset, you make yourself look good. You make yourself look good. So if you overstate an asset, you're going to have income that is too high. And here they're giving you a slide which is trying to show you the error. Let me go, if I may, let me go into my little presentation here in Excel. And give me 1 second to...
Bob, are you going to be doing lectures for all 3 of the chapters then that we have this week?
Yeah, I think so. I think that's, yeah, because we don't have another test till the end of the semester covering everything after chapter 7, I guess.
Mm-hmm.
If you look at the syllabus. Yeah, and I'd like to go through the chapters one day at a time to give us plenty of time for a review. That's the way I'm looking at it.
Well, I think Cornelia wants us to read all of them by, what is it, Christine, is it Wednesday? We're reading all 3 chapters and then we're doing homework all together and then we're doing the tests all together.
Yeah, we have to do, we have to turn in our summaries by tomorrow.
When is your next test? From what I saw, there's no test till the end of the semester. Am I wrong?
No, that's right. On the 22nd, which is next Tuesday, a week from tomorrow. That's our final.
Okay, and that's your next, okay, yeah. I'll catch up. If we have to do, are you thinking, Natasha, we got to speed up the pace here?
No, I was just wondering if we're going to be able to hear you lecture for the rest of the chapters.
Absolutely,
that
absolutely.
are due this week. Okay.
Absolutely.
I'm learning more from you than the book right now.
Oh, that's good to hear. All right, so we're done with the book, okay?
Yeah, I think I'm done with the book.
Out with the book. You know that Bruce Springsteen, you big Bruce Springsteen fan, Natasha? Probably not, huh?
I mean, he's okay.
You like Bruce
But
Springsteen?
Sure.
By the way, Christine and Natasha, did I ever tell you this little bit of trivia? Where I grew up in New Jersey, there were three remarkable people who grew up within 10 miles of each other. All the class of 1967 in high school, right? Different schools. We didn't know each other back then. One is Meryl Streep, the actress, you know her?
Hmm.
One is Bruce Springsteen. And you know who lived right in the middle of them? Me. That's the third one.
Wow.
Nice.
Let's not forget that, all right?
That's
Nice.
cool.
Here we go. Here is an example of what happens if you understate or overstate, okay? This is our new income statement format. Remember, we're going to start with the sales, and we have to go through all this stuff with beginning inventory plus purchases gives us what's available to sell. And then we're going to subtract the ending inventory to get the cost of goods sold, okay? We get the cost of goods sold, and then we can come up with the gross margin and whatever, okay? So the correct inventory amount was $60,000 this year, okay? But we made a mistake. We only counted 45,000, okay? Watch that yellow number. Watch those two yellow numbers. What happens now if we understate? Look what it does to our net income.
We're not seeing it, Bob.
What's that?
We're not seeing it. Christine, are
for
you seeing
Pete's-
it?
I'm so sorry, guys.
No, I'm not.
Sorry. I was putting on such a good show there. Hold on. Jesus. Come on, share. Oh, yeah. Okay, here we go. Do you see the spreadsheet now?
Yeah. Yes.
Hi, Patty. How you doing?
Doing good.
Okay, here we go. We were just talking about what happens when you fail to count the inventory correctly at month end. There's a couple things we need to understand. And that is, if you make a mistake counting the physical inventory at month end, you have botched up the financial statements and all of the financial statements for that month. And the next month is going to be wrong as well. So undercounting an inventory in a particular month means that you're going to understate the net income. If you overstate the inventory by mistake, it will overstate the net income because it's going to look like you have a lot of stuff there still sitting in inventory. You're putting up an asset you don't have. So if you have a mistake that goes minus in one month, it's going to have the opposite impact the other. So let me get back to this. The correct income is $65,000. But let's suppose that see the number in red, the 60,000 less ending inventory. Let's change that to 45,000. Keep your eye on the 65 and the 175. What happens when I make this entry? What you should see is the 65 will fall to what would that be? 50,000. The other one should go up to 190 if there's a God in heaven. So let's take a look. You get a feel for it that way a little bit, Patty? What we're saying is we understated the inventory. This should have been $60,000. This is correct, but we understated it. If you understate the inventory, and let's understate it again by $45,000, we're going to report, instead of $65 million in profit, we're only going to report 50 million. And in the next month, instead of having 175 million in profit, it's a big company, we're going to end up with 190. So let's just understand that relationship, okay? Because this can really be a problem. If a company makes a significant error like this, like I was saying before, they just have to announce it to the public and throw up their hands. So we goofed. You see that wall over there? We never counted that wall for some reason. And that's why our financial statements are no good. And I'm going to tell you a real life story, if you don't mind, for about 1 minute. Where I worked at Thomas and Betts all those years, we did a lot of what was called intercompany accounting, where my factory would sell a raw material to a factory in Texas, and we bought raw materials from a Thomas and Betts company in Pennsylvania, etc., in New Jersey. And intercompany accounting is very important. You don't want to go out of balance on what's called an intercompany basis. And we had these kinds of mistakes made. And it was such a serious problem that all the accounting people, the big, no, I don't want to call myself a big, but all the controllers and VPs and stuff, we all got a phone call like on a Monday to jump on a plane the next day for them to yell at us back in New Jersey for causing this problem. So the point is, you make a mistake one month, it screws up the next month exactly the same way, okay? Now I'm going to go back to our slides. You can see the slides, right, Christine? Okay. And for those of you who came in late, we were just starting with this, so you didn't really miss anything of great note. Okay. What we've been doing so far in this course is teaching what's called the periodic inventory system. The periodic inventory system refers to a process where you are not recording the cost of goods sold at the time of the sale. When you sell something, you debit accounts receivable and you credit sales. You don't do anything about reducing the inventory. You just sold something, but under the periodic, you're not going to touch that account until the end of the year when you take the physical count, okay? That's the periodic system. Most of the world, I would think, certainly majority, most of the world, big and small companies, are probably on what's called a perpetual inventory system. What this means, the moment they record a sale in their system, they're going to have the same journal entry. They're going to debit cash or accounts receivable, and they're going to credit sales, but they have another two-line journal entry that goes with it, and that is to debit cost of goods sold and credit the merchandise inventory. And that should make sense. We just sold something for, say, $1,000, and we paid $400 to bring it into our store. So that $400 is the cost of goods sold. The difference between the two would be the profit on that. And there are a couple of other differences we're going to look at now. Here we go. You need to study this. Study. Under the periodic system, this is what we've done so far. Periodic, perpetual, a lot of differences. So let's see if we can get a little handle on this, okay? Under the periodic system, we are debiting purchases. That's all you've debited when you buy something, right? You debited purchases, you credited AP. Purchases is a cost. It's an expense that we really adjust at year end when we count the goods physically. Under the perpetual inventory system, you have the same entry, except we're not debiting purchases. We're debiting the inventory. We're debiting merchandise inventory. Purchases is a cost that requires a year-end adjustment. Merchandise inventory is an asset requiring no particular adjustment until the end of the year, okay? Look at freight. Under the perpetual system, we're going to just add the freight directly to the inventory account. We were doing that on this side as well, but we were first putting it into expense. And then when we went through that business of beginning inventory plus purchases, plus freight, minus it, then it rolled into the cost of goods sold and inventory. So you're going to be debiting merchandise inventory in this chapter. We sold something for $80 that cost us $50. The sale account, like I just said, is the same. You debit accounts receivable, you credit sales. Here, though, we don't know what we have in inventory. We have no idea. We didn't take it out. Here, we know that this was $50 item. You debit cost of goods sold and you credit merchandise inventory. And that can be one 4-line entry, if you like, or separate entries. Doesn't make any difference. Okay. Merchandise was returned to the supplier. We returned something. Well, we don't worry about purchase returns and allowances because in the perpetual, there's no such thing as purchases. What did we return? We returned inventory. We returned inventory here too, but we don't know what the balance is in the inventory at this point, and we're going to take care of it at year end. So you're dealing with merchandise inventory. A customer returned something that we sold for $20. Well, under the periodic, we debit sales, returns, allowance. Of course, you never debit sales, credit accounts receivable. Same entry, same exact entry under the perpetual system. But again, they're adjusting all the time to the proper balance. They're saying, yeah, that $20 item cost us $15. We're going to put that 15 back in the inventory and reduce our cost of sales because we have another shot at selling it. And then they paid for merchandise and they are going to take a $2 discount. $2 discount. Just remember, under the periodic, what's called a purchase discount is called inventory here. So one little tip might be on the perpetual system, you'll never see the word purchases, never. What you will see is inventory, merchandise inventory. Anybody question on that? Okay. It's a little tricky, and it's just a matter of, due diligence on your part, looking at this, understanding that on purchases are periodic, but not perpetual. And by the way, a perpetual inventory, as you probably already know, means that at any microsecond of time, the company knows exactly how much they have left in their inventory and what the cost of those goods are. That inventory is there every second of the day. If you call up Costco now, if UCSB called up Costco and said, hello, we're looking to buy a dozen 75-inch flat screen TVs for our new dormitory, Costco, the clerk there, the salesperson, would just put in the part number and immediately it would pop up. We have 20 of these left. And you could tell that, yeah, well, sir, we have 20 if you want to buy more than 12. Without a perpetual system, you get that annoying, could you please hold? And now you're on hold waiting for the person to run out and see what they have. So the perpetual system is superior in all ways. Now we get into some fun stuff. Compute the costs allocated to the ending inventory and cost of goods sold using different inventory methods. Companies are allowed to select their own choice of how they're going to cost their inventory. It's similar to depreciation. There are, a number of depreciation methods, straight line and double declining and weighted average, all kinds of things. Here, there are different inventory methods. And one inventory method is going to give you a different net income than the other. They're all going to give you different net incomes. One will give you a higher, one will give you a lower. So let's talk about this a little bit. To determine the cost of goods sold in the ending inventory, understand the purpose of a physical inventory. If you have to take a physical inventory, the specific calculations ruled under the, this is just key concepts. I'm sorry, I thought I was getting into something deeper. To determine the cost of goods sold in inventory, yeah, we're going to understand more of the purpose of a physical inventory, the different calculations, and the lower of cost or market rule. Taking a physical inventory, you have to do it on the periodic side. You have to do that. You have no choice. The perpetual system, you probably don't have to take a physical inventory. You might want to do it anyway for your own comfort. I mean, we had a pretty decent perpetual. This is like 40 years ago. And we took an inventory at the end of the years. At the end of the year, the auditors would come out and join us. And some of the big shots would use it as an excuse to come to Los Angeles for a week and, have some fun while they watched us count the inventory. Under the perpetual system, you may not have to do it. And this is just an inventory card. You know me with the forms. We don't have to really worry about this. This is what the storeroom has. Let's go over a couple more terms. One we did a little bit in chapter 12, I believe. Consignment. Consignment. Goods on consignment. Goods on consignment. Consigned goods belong to the shipper. Consigned goods belong to the shipper. And you heard this the other day, right, Natasha? If you walk into Macy's or Nordstrom's, you smell the perfumes right away on the first floor, especially Macy's used to be. Well, they had all these containers of perfume and colognes arrayed around glass cabinets. Those jugs of perfume belonged not to Macy's. They belonged to the company that shipped them there. Arpel, Chanel, Dior, all these fancy French companies. And what consigned goods is as follows. You give a jug of perfume to Macy's, okay? And the deal is Macy's can sell it for whatever they want. Well, Macy's sells it for whatever they can get. Maybe they were able to sell it for $100. Your deal with Macy's is that when they sell it, they pay you $60. That's how consigned inventory works. At the end of the month, consigned inventory has to be counted in your physical count. Otherwise, you are messing up. So understand the world of consignment, okay? And a lot of retail stores work with that. I happen, not that I'm an expert in perfume, but I happen to hear from a few people that perfume is typically one of the things most consigned, okay? Now, we already went over FOB, right? FOB, shipping point and destination. FOB shipping point. FOB shipping point. FOB is simply the point in time where the goods change hands. It's the point in time where title to the goods passes from the shipper to the receiver. So if you ship something FOB out of our store here on our campus, FOB shipping point. The minute our truck turned it onto Cliff Drive out here, we don't have to worry about it because title changed at the shipping point, which means the buyer is responsible for everything. It's the buyer who must pay the freight. It's the buyer's insurance that covers everything. If something goes wrong, the buyer is responsible for it, okay? FOB destination is different. When that truck leaves us and it goes turning down Cliff Drive, and just before it wants to turn by the 7-Eleven, the truck blows up. The driver was fine. No, nothing happened to the driver. He was okay. But the goods blew up and burned away. We would be stuck with that because we own it until it gets to New Jersey, okay? So FOB is the point in time where title changes to the goods. Think in terms of shipping point, destination. You could have FOB Chicago. You could have FOB to Rocky Mountains. It's just a point in time where the goods change and thus the responsibility changes. Inventory cost components. Okay. Remember, we just said that we don't debit freight in on the perpetual side, we debit merchandise inventory. Yeah, that's because the value of an inventory item is not just what you paid for it. It's going to be the purchase price, say $1,000. We bought something for $1,000. The freight was $100. So now we have an $1,100 item. Maybe it was such a special item, we had to have special insurance as it came to us via airplane or something. And if it required some special storage, we had to build a refrigerator or something. Those type of costs could be added to the price of the asset, okay? So just keep in mind that the price of the item on your balance sheet is not necessarily the $1,000 you paid, the $1,000 plus the freight plus the insurance, okay? Storage fees, I'm not too sure about. Here we go. Identical items are purchased at different times and at different costs per unit, huh? Prices are going up. Prices are going up. You want prices to be going up. You want prices to be going up reasonably. You need a certain amount of reasonable, mild, let's call it inflation for a healthy economy. Workers have to think that their hard work is going to pay off with a raise. Some of it is psychological and some of it is Keynesian, I guess you would say. So of the goods available for sale, how do we decide which were sold and which units remain on the shelf? Now, again, in this book, not in the book, but on our tests, in my presentation, anything Cornelia sends out, assume it's a period of rising prices. Understand the rules of LIFO, FIFO, specific ID, and weighted average, assuming rising prices. It's just going to be the opposite for lower prices. But teaching a lot of lower pricing economies, that would be very depressing. That would be murder. That every day you wake up, you make less per hour. Maybe you still have the same buying power, but it sure doesn't sound like it. Okay. So we have four methods we're going to work with, and I'm going to go in the order that is the normal order. Okay. And I'm going to go for FIFO. Woo-hoo. FIFO. First in, first out. First in, first out. The latest goods purchased remain in the inventory. Keep in mind that we are pretending this is true. 3 of these 4 methods you're going to learn have nothing to do with the actual physical movement of the goods. Okay? FIFO. We're just assuming that we're always selling the oldest stuff first. And that's pretty much the case in most businesses. So this one is pretty close to the way the materials go, but not necessarily. Whenever possible, a business will attempt to sell the older stuff. I guess that's true. Certainly grocery stores, bakeries, computer dealers. FIFO often follows the actual movement, but not always. I wouldn't even say often. It does not really. So let's take a look at our first calculation here. I'm going to show it to you here, and then we're going to do it on my Excel sheet, okay? FIFO, first in, first out. Well, it all begins with our new income statement section. It all begins with taking the beginning inventory, adding all the purchases, and getting something called total available for sale. Total available for sale, that line is, okay? We had 200 items, okay? Now, they were sold on the basis of FIFO. FIFO. So my question to you is, we had 200 available. How many? 200 available. I just want to see something. They got to tell us how many they sold. It's got to be 150 sold. All right, here we go. Just want to check one last thing here. Okay. All right. Well, they're telling us that they sold 150. We know that from the end of the inventory. That's a clumsy way to show you, though. It should have been very clear up on here. Sold 150 items, okay? We know we sold 150. Which ones did we sell under FIFO? Well, we sold the oldest first, right? First in, first out. We sold 40 times 62, 60 times 65, 80 times 67. That's 40 plus 60. But we needed 150, right? We got 40 from here. We got 60 from here. That's 100. And we only needed 50 out of here, which left us with 50 in the tranche, okay? And by the way, this is not correct over here. I can see that. Let me take it to the Excel sheet, and let's see if we can make it much clearer than that, okay? All right. Okay. I'm working with your numbers now, okay? We had 40 to begin with, okay? then 60, 80, and 70, 40 and 60. It's a total available of 250. We know we sold 200. We know we sold 200. So where did we sell? Where did we pick up those? Oh, come on, will you? Come on. There we go. Okay. So let's do the cost of goods sold part first. Well, we know we sold 40, right, from here. We know we sold 60 from here. Well, that's 40 plus 60, that's 100. We sold 80 from here. So that's 180. That means we had another 20. Let me just insert a line here.
Are we supposed to be seeing the spreadsheet?
It would help. Yeah, sorry, God almighty.
I just wanted to make sure. It's okay.
Jesus. You're asking some good questions. Can you see it now?
Mm-hmm.
Thank you. Getting a lot of flop sweat today. Come on, let's go. All right. I just want to do something here. Beginning. Oops, not there. Okay. We had 40 come out of the beginning inventory, 60 out of the first purchase, and then the other two came out. 40 and 60 is 100. And here we only needed 20. So there's the 200 we sold. And hold on here, please. Hold on. You still see the spreadsheet?
Mm-hmm.
Okay. So we sold 40, 60, and 80. So this is 62, 65, 67, 68. We just extend the arithmetic out here. Okay. Move that out of my way. And there we go. So it's just a matter of adding this down here. Let me fix this. Hold on one second here. Okay. All right, we just add this down. This thing is giving me a hard time. It's not letting me use my super shortcuts. 200. That's the 200 we sold. And this is the cost of goods sold. Oop, again, I can't use the shortcut. Okay. Make a little bit of sense what we're trying to do here? We're trying to identify which of these we sold. Well, we sold 200 out of that 250. How much was in the final purchase? 70, right? How many did we sell out of that? 20. So our ending inventory is going to be 50 units sitting there from the third purchase. And that's $68. 50 times 68. What's that? 16,500. How much was available for sale? 16,500. Do we all see that there? That 16,500 is either still in the inventory or we sold it. Well, we know we sold 200. Under FIFO, we sold the 40, the 60, the 80. That got us up to 180. We only needed 20 from here. So the cost of goods sold is 13,100. And the ending inventory balance is 3,400. Add those two together. 3,400 plus 3,400 plus 13,1, that equals 16,500. What do you think, Ms. Sasia? Making a little bit of sense?
A little bit.
It's a little tricky when you first do it. A little tricky. Let's change it. Let's go to LIFO. LIFO. Now we're selling the newest stuff first. LIFO. Last in, first out. Now, there aren't too many businesses that sell the most recent thing that came in before selling the older stuff, okay? But again, we're just pretending. These are methods of what's called allocation and estimating that are okay under GAAP, okay? These methods are all approved by GAAP. They all give different methods. Mesa Produce up here. I happen to know they use LIFO to do their financial statements. Did you know that? Theoretically, that means they never sold the first bunch of bananas they put out there after World War II. Now, we know that's not very likely, but they're allowed to pretend that. But you might be thinking to yourselves, are there any businesses at all that never sell their beginning stuff? And the one example I could think of, and maybe you guys can tell me more, you ever go into a hardware store and you see a 55-gallon drum filled with nails, and there, there's a little oil in there, keeping them fresh? Nails, right? You fill it. You started this business back in 1900. You fill it up with nails, and people take nails out. You weigh them, and then the nails get maybe 4/5 done. You don't wait till you sell the final darn nail. You just dump the newest nails on top. So I think that's an example. Anybody think of anything else? I can't.
No.
That'll be on the test. Name 3 businesses that never sell. No, that's not going to be on the test. So let's look at LIFO, okay? Let's look at LIFO. We have the same information here. In fact, let me just copy all of this over real quick if I can. All right, perfect. Okay, let's do LIFO. LIFO. Yike. LIFO. There we go, LIFO. Okay, notice that the cost of goods available is always the same. That's always the same, okay? The difference is what did we sell? So let's get rid of that. We know we have 50 in the ending inventory, so we can kind of keep that there. We don't know what the cost is going to be necessarily. So let's figure this out, guys. Let's do it this way. Delete. Come on. Okay. Let's delete. Okay, here we go. All right. Anybody want to tell me which ones did we sell? We're looking for 200. Which ones did we sell? Anybody want to start me off? Last in, first out. Well, the last in was the third purchase, right? Last in. Under this method, that's the one you sold first. So we know we sold 70 at a cost of $68. We know that. We go back up. What would be the next one? Nastasia, you hiding there? What would be the next one? Went back and hit again. The 70 was
Yeah.
the newest. What's the second newest? The 80, right?
Yes.
You see where I'm going up here? 80 times 67. So that gets us up to 150. How many do we have in the next level? 60, but we only need 50. 50 times 65. There's our cost of goods sold. Let's do the ending inventory. The ending inventory has two levels, huh? The ending inventory. Let me just do something real quick here, fix that. Come on. Okay. So what's still in the ending inventory?
10
Yep, 10 from where? The second purchase, right?
from the
First purchase.
first purchase. Yeah.
Thank you. Thank you. And where'd we get the other 40?
Oh, from the
Second.
beginning inventory.
There you go. Beginning inventory. Okay. So we had 10 from the first purchase, right? And then 40 here. So 10 is at 65. This is at 62. We come up with the arithmetic. I don't know why the formulas are disappearing on me, but that's okay. My goodness, this thing doesn't love me today. Oh, God. And there we go. There is our, what happened there? Plus that times that equals. And so this would be 5,200. So
Wait,
let's see what happened here.
that's wrong, right? Is it? 'cause
Something's
that-
wrong there. Yeah, huh?
Yeah.
The 10 should be 65, right? Tell me what's wrong, Christine. You go right ahead.
Well, the total's wrong on something because 10 times that equals that, but it can't be the same for the 40.
What the heck happened here? Okay.
That
Now, I think the other thing that wrong is the 40 is the 62 because we never
Right.
got to the older.
right.
Were you gonna comment on that?
Yeah, that was my next.
Okay, there we go. 3130 plus 13,370 equals 16,500. 16,500. Oh, for some reason, it's blocking me out of all the good stuff. 31, 3370 plus that, plus that. Might as well do it in pencil. Holy Jesus. Good Lord.
If you didn't have days like this, you wouldn't appreciate the other.
Yeah,
day.
right. Yeah, right. Thank you. Thank you for the encouragement. Okay. LIFO, FIFO. Whoo. These are the ones that make you think a little bit. The other two are a little bit easier. Weighted average, average cost. You see what we have it over here? Here, it's easy because you don't have to worry about, well, we took 10 from this tranche and 12 from this one. All we're doing here is getting the average cost per unit and multiplying it out by the inventory and the sales. So let's take a deep breath. Let me put our numbers in. I'm going to step on it up here. Okay, now we're doing average costing. Okay. Let me just do this real quick. Put it out here. Okay. This will only take a second to fix. Okay. We got the same information going, right? The goods available for sale. Now we're doing the weighted average. So here, I'm going to delete a whole bunch of things we don't need. Oh my goodness, look at all this we don't need. Okay. All we need is, how many did we sell? Sold. How many do we have in the inventory? We sold 200, and in the inventory we had 50. That's all you have to do in terms of the quantities. The average cost is as follows. You ready? You take the 16,500 and you divide horizontally. You divide it by the 250. And that gives us a price of $66 average cost per unit. $66 average cost. Don't make this mistake student make. They go, okay, I get the average of these four numbers here. They go 62, 65, 67, 68. That will not give you the correct number, okay? That will not work. So what's our average cost, everybody? $66.
66.
There's your cost of goods sold. And there is your ending inventory. And guess what? It adds up to 16,500. That's pretty easy, huh, Christine? That one's not too bad. How you doing, Krista? You following along there? Uh-oh, Krista took a break here. Hold on. The guys are out here. The gardeners are here. Let me go back to the book for a second. So they're presenting these methods here. Okay. Remember, everything starts with the available number. The available number is the same for everything.
Are we supposed to be looking at the book or the spreadsheet?
Oh, no, no, you're not supposed to be looking at anything yet.
Okay.
Here we go. Okay. Using the specific ID method. This is pretty easy in a way because they tell you where the goods came from. They're telling you that 30 came from the beginning inventory, 50 came from the first purchase, 60 and 60 from purchases 2 and 3. So that's how you would cost those out. 30 at 30 times 62, 50 times 65, 60 times 67 and 60 times 68. And here's what we're looking at. They said they sold 30, 50, 60, 60. They told us that. 30, 50, 60, 60. 30, 50, 60, 60 times the unit prices gives us a cost of goods sold of 13,210 and an inventory of 3290. Now, let me point something out that's very, very helpful, very simple, and I think some of you probably already noticed this. Once you take the cost of goods available and you come up with the cost of goods sold, the cost of goods available minus the cost of goods sold equals the ending inventory. The cost of goods available minus the cost of goods sold equals the ending inventory. Therefore, the cost of goods available for sale minus the ending inventory equals cost of goods sold. Keep that in mind if you get any of these type things on the test, and you should get little tiny figures to do here. For example, they might tell you the beginning inventory was 100, the beginning inventory was 10,000. Then you had purchases of 6,000, 5,000, and 25,000. And then they tell you the ending inventory is 20,000. Well, just by reading that, you know that 20,000, if it's FIFO, had to come out of the end there, and you already have the number. My point being, it's easier to work with the small number than the big one, okay? So when you're doing these problems, same thing with your homework. You might have a shortcut by doing the smaller number first. Might be easier to do the ending inventory first, then the cost of goods sold, okay? First in, first out. There's one other thing I'd like you to show you before. We got one other thing on costing and then one other concept to review. This is important, huh? Compare the inventory methods. Well, we did specific ID, we did FIFO, weighted average, and LIFO. Let's start with FIFO. What was the gross profit for FIFO? $4,900. We see that? 4,900. What was the gross profit if we use LIFO? It's much lower. It's 4,630. The weighted average, as predictable, it's right in between the two, somewhere in between. And specific ID can be anything. Specific ID came out to 4,790, okay? Companies have a choice. They have a choice between FIFO, weighted average, and LIFO. Specific ID, you really don't have a choice. Certain businesses must use specific ID. And we're talking big ticket items. I bought a car. When I bought my Maserati a couple of weeks ago, when I went into the Maserati shop and the guy said, okay, your check cleared, he didn't say go out to the parking lot and pull out any Maserati you want, just drive it away. No, I had to take the one that had the right serial number, the VIN number, the engine information. Anything big ticket item has to be specific ID because you are in the problem area of needing to track it in the event of a recall. In fact, my real car, the Ford Edge I bought 5 years ago, that just got a recall. I haven't taken that thing up. They're telling me the brakes are shot or something. So the reason they did that and could do that was specific ID. So specific ID is kind of forced on you. Airplane manufacturers, big ticket items, people who make forklifts, stuff like that. The choices are really FIFO, weighted average, LIFO. FIFO has the highest income. Weighted average is between the two. LIFO is the lowest. Why would anyone choose LIFO? Anybody have any ideas why you would choose LIFO? You're showing less income.
Is it? Never mind. I thought I had it in my head, but I don't.
You save on taxes.
Exactly. Save on taxes, right? Let's say
I
this is
cheated, Christine. I watched the previous one. I mean, that's why I know.
There you go. Nice going.
Awesome.
Yeah.
Yay.
Yes, they're going to save on taxes. Their net income is $270,000 lower than the FIFO guy. At 30% times 270, that's $81,000 they saved. All right, Nastasia, why did they choose? Why would somebody choose the big one, 4,900? Why would you choose to pay that tax if you didn't have to?
If you're trying to show off.
Exactly. Ah, you're picking up this lesson good, Nastasia. Keep going.
I hope
Yeah.
so, because we got a lot more to do this week.
Yeah. The reason you might pick FIFO is you always want to put the best possible foot forward to the public. You want to be able to make a big splash. You know, Joe's Cocktail Company announces record earnings of 4,900,000. Woohoo! And that draws attention. That draws headlines. Now, institutional investors, they know all these little tricks, but it is a way to get attention. Weighted average, you're being conservative, I guess. We don't want to go too far either way. Okay. Inventory costing methods. The perpetual inventory system. I am not going to go over this grid at all. I don't think it's going to come up on the test. I'll ask Cornelia, and I can always go back to it. Okay, here's a new gap principle. Conservatism. Conservatism. What this simply means is this. You never anticipate gains. You always anticipate losses. Okay? And I'll go back to my famous example I've been using the whole semester. Your grandfather bought property on Santa Barbara for $10,000 that's now worth $10 million. Well, that property is still going to be $10,000 on the financial statements until it's sold to somebody else. But if that asset of $10,000 turned out in a few years not to be worth $10,000, if you were unlucky enough to buy the only acre of land in Santa Barbara that's on a toxic waste dump or something, and they can never use that land, that would be bad luck, and you'd have an asset that's worthless that needs to be written down. So conservatism, you always anticipate losses, you never anticipate gains. And that brings us to the lower of cost or market, okay? Lower of cost or market. If the value of an inventory item declines while it is being held, the loss should be recognized in the period of the decline. Purpose of lower of cost or market, recognize such losses on the income statement and report the lower inventory balance on the balance sheet. What do we mean by cost or market? Cost is obviously simply what we paid for it. What is it costed at on our books right now? Market means what would it cost to replace it today? The price in the market in which the goods are purchased, not the price in the market in which the goods are normally sold by the business. In other words, we bought something for $20. We bought a bunch of t-shirts for $20, and they were selling like crazy, selling. And then we went out and we bought another 10,000, and then suddenly that shirt went out of style. No one is buying them anymore. Our salespeople are coming back to us saying, those $20 sweatshirts, t-shirts we used to sell for $30, we're never going to get that much money. We'll be lucky to get 15. We have to recognize that $5 difference as a loss, And I'm going to give you two examples, and then we'll get us out of here, okay? Lower of cost or market. This company has three items. They have an item one, they paid $8,000 for it. But you know that if you bought it today, it would only cost $7,000. Nobody's going to give you $8,000 for it. $7,000 is the most. So you have to change the $8,000 to $7,000. Here, look at this one. We purchased something for $9,000, and if we replaced it today, it would cost $10,000. What's lower, cost or market? We bring the $9,000 over. We have a third item. Cost $7,000, market $6,500. What's lower? The $6,500. So that gives us we have to make an adjustment of $24,000 minus the $22,500, which is $1,500. $1,500. And look at your journal entry. That should say $1,500, by the way. You credit the inventory. Your inventory is not worth that much anymore. And you debit an account called cost of goods sold dash loss on write down of inventory. We called it cost of goods sold dash lower cost of market. Okay. Now I'm going to go back one last time to my Excel and I'll let you know. Okay, let me bring it up for you. Share screen. Here's what we're talking about. Kind of the same thing. You've got an item on hand, 140 of these things. The cost was $8, and 8 times 140 is 1120. Okay. But the price is now $950. So we don't have to make an adjustment. It's still going to be the 140 times 8. Here's an item where the price went down, 4 to 350. So we have an adjustment to make of 50 cents. So that would be times 90. You getting the idea? Make sense, Patty? Not too tough. Here, the price is high, the cost is lower, cost is lower, cost is lower. So all we have to do is bring over the current carrying cost. So there we go. I should have put a total here, I guess. So we had an inventory that had a value of 48.15, and now it's going to be a little bit lower. $47.70. The difference between the two is $48.15. It could be a very small number. $45. There's our journal entry. We debit cost of goods sold, lower and what do we get a credit? The inventory, merchandise inventory. Okay. Not too tough? I hope not. Now hold on here. Let me get back into the lower of cost or market. And with that, we are done. We're not going to go over this retail method, these methods of estimating. Okay. So that was a pretty lengthy chapter. There's a lot of stuff in there. None of it, I don't think, is daunting as long as you keep up reasonably well with the homework and the chapter summaries. Anybody want to make a comment? Any question? Hey, Nastasia, was this better than Saturday or both bad?
I like them both. You should do 2 per chapter. I think that would help me.
For those of you who came in late, let me explain something, what we're talking about. When I woke up Saturday morning, for some reason, I thought it was Friday. I sat down and I went in, not to tutoring, but into the classroom. And I sat there and I waited for some people to join the class. Nobody showed up. So I did the class. I did this lecture already. And during the class, I'm saying things like, where are you guys today? How come I'm the only one here? Well, you know, and not only did I make that stupid mistake, Nastasia now tells me that for the entire lesson, I never shared any screens. So anyway,
Oh, that's classic.
Yeah, as bad as this episode might have been, as clumsy, this is better, okay? So I'll let you guys go. I guess, well, do you have any questions? Anything, Patty, Christine, Krista?
No,
Nope.
I'm good.
You good,
Yeah.
Krista?
Sorry, I couldn't
I'm
make it
good.
last week.
All right, we'll see you all on Wednesday. We're gonna hit chapter 14, okay?
All right.
See you
We'll
then.
see you.
Thank you.
Hey, bye-bye.
Thanks so much.
Bye.
Bye.
Thank you.
Actually, I have a quick question, just a matter
Oh,
of.
okay, you caught me right on time, Patty. Go ahead.
Yeah, it's fine because I'm just going to do the summaries all today anyways. But I was wondering why we're doing all the summaries due tomorrow and then doing the homework due on Thursday and then like the
Yeah,
quiz.
Cornelia thinks that's the best sequence. That's her,
Yeah, okay,
that's
that's fine. I'm just curious if.
that's her mindset. Yeah. Yeah, students are saying, geez, we have to do the summary before we even see the lesson, right?
Yeah, it's the it's just that it's what's it called? The summaries are the longest part of all of this.
And
So-
this, and you don't want to neglect the summaries
Yeah,
because those are 40 points that I think whatever it is in this class, 40, whatever it
I
is.
think it's 40.
Do you remember me saying that usually during the semester she stops correcting everything and turns it over to me?
Yeah.
That happened this morning. So
All
so
right.
this has been going on for like 5 years. Every semester, we're supposed to share the class. So she's dumped everything on me, except issues with the computer, or if you're looking to get your grade raised or something, you would talk to her. Okay.
Sounds good though. Yeah, have a good one. I'll see you Wednesday.
You too, Patty. Bye bye.